The views and opinions expressed in this podcast do not necessarily reflect the views or positions of ACUMA, its board of directors, its management staff, or its members. The podcast discussion presented is conversational in nature and for general information only.
Hello and welcome to ACUMA's On Point Podcast, a series focused on sharing the stories of people who are making a positive impact in the credit union mortgage industry. I'm your host, Peter Benjamin. Today, my guest is Shannon Faries, Director of Risk Management with Land Gorilla. Shannon, how are you doing today?
I'm doing great. Thank you.
Awesome.
Happy to be here to talk to you and all your members. This is a great opportunity for us, and I have a lot of involvement with credit unions, and so I'm a big promoter of the credit unions and your space that you're in. And at some point, I want to talk a little bit about what it is that I love about the credit unions.
Sure. And we'll get to that, I promise. We'll get to that. And thank you very much for being here. But before we get too further, I need to bring in Justin. Hawk, how you doing? What's the latest and greatest happening over at ACUMA? Give us the greatest update ever.
I'm good, Peter. Thank you. We are busy. If you don't know, and I'm sure you do, but
of course, I live and breathe it, brother.
I know. Next week not next week. In just under 2 weeks, we're heading to the Viewpoint Regional Summit in Phoenix. So that's exciting. So if you haven't had time to register or you're on the fence, it's a free event, open to credit union members only. Mm-hmm. There's still time to register. Head over to the website for more information. And then coming up in May and June, we go to our focal point workshops. So we'll be in Nashville in May, and then in June, we'll be in Denver.
Yep.
Registration is already open now. So
opened earlier this month, right?
Yeah, we just opened it 2 weeks ago.
7th, right?
Yeah. So that's exciting. We're seeing some people start to register now and, come out, see us. I know Peter says that's one of his favorite events. That's why he fell in love with ACUMA. So if you want to see what that's all about, I think that's one of the best things that we put on too. Then coming up after that, a little further down the road, but in September and October, we'll be in Vegas for our Make Your Mark annual conference. So the agenda has been building up pretty much since last year. We're excited about the lineup.
Really are.
We have some amazing speakers lined up. We're certain that everybody's going to love them too. So stay tuned for more information on registration and all that kind of fun details. And then other than that, we have our fast tracks and inside track webinars. Those go on year round. So you get a chance to take in some of the hot topics and really just continue to educate yourself on things that are affecting the credit union mortgage industry. And then the last thing is coming up on the 28th of February. So next week is our Q1 quarterly Young Professional Network meeting. So it's open to all credit union young professionals looking to network, share, learn, and grow their professional careers. So you still have plenty of time to register. It's a virtual event held by Cameron, what is she?
The amazing Cameron.
Yeah, no, I was like the amazing camera, the magnificent camera. I couldn't come up with a great alliteration for C, so darn. But yeah, so lots of fun stuff going on. Lots of things to take in over the next few months, all the way through the end of the year. We look forward to seeing all of our members come out and see us.
Right on. And, a couple things. Excited for the regional summit. It was new last year. Couldn't have been more happy with how it turned out. I really think that this year will be just as amazing as last. We had a great group of credit unions coming out, a great list of speakers. So really looking forward to Phoenix in at this point, 2 weeks or so.
2 weeks. I'm not going to lie. I'm really looking forward to the warm weather. The East Coast has been kind of frigid, so
no, it's not that bad.
It's been cold.
No, it's not that not that bad. All right, well, awesome, Justin. Thank you very much for the update. All right, let's turn the attention over to Shannon. Now, Shannon, I'm happy you were willing to come, be our guinea pig on the On Point podcast. For background, you're someone who I hold in high regard in our industry, and admittedly, you were very instrumental in my success when I was at Lafayette, and for our listener and for background to kind of help out with our listeners and kind of paint that picture. I rolled out a construction and perm program at Lafayette, and it was a very good program, something I was very, very proud of. But the number of hours I spent on the phone with you, kind of hashing through that program, and really getting it to a point where I knew that it was good for our members. It was good for the organization. It was a loan that, yeah, we could keep on our books if we wanted to. Actually, part of it we could. At the same time, we could easily turn around and sell to Fannie or Freddie. So I was always appreciative of you. I always respected the amount of knowledge that you had for construction of perm, but also the passion that you have for it. And so I think that was kind of the idea behind sitting down with you, knowing how passionate you are. Even after I became president of ACUMA, we've sat down and had several conversations about, the need for credit unions to kind of jump on that construction of perm bandwagon or really start considering it as a viable option. And so that was really why we wanted you here, right? Let's kind of talk about that. I think it's a good platform for us to really focusing on is the opportunity that lies ahead for credit unions in that construction, the perm space. And again, it's not so much what they need to do once they have the program. That's a different conversation. This is why they should really consider it as a viable solution for them, especially in today's market. Now, before we kind of dive into that conversation, let's really focus in on you. Let's focusing on Shannon Faries. Kind of give us a little background behind you, how you got into this industry, what drives you. Let's focus on how did you get into this industry?
I got into this industry, I guess you could say, sort of by accident. Everyone has a different path.
That's everybody. We've heard that.
Everyone has a different path into mortgage finance. There's no one way. And in my case, I immigrated to Phoenix, Arizona, and took a job with a national mortgage company, a bank-owned mortgage company, to become a retail loan officer. And up until that point, I couldn't even spell mortgage. I had no idea what the mortgage industry was all about. But
it's a double G that always gets me. It's a double G.
I got really lucky because I learned the right way to do things from a very well-schooled and very professional group. It happened to be owned by a bank out of Oklahoma, but the mortgage company itself was very, very professional and very adamant about learning things the right way, doing things the right way, not cutting corners, always being transparent, things like that. And of course, being a real young person, young, dumb, and naive, I thought every mortgage company operated that way. And of course, I learned later that's not the case. There's many different variations of mortgage lenders, mortgage bankers, mortgage brokers, all that type of stuff. But I got lucky, because I was assigned a retail area, which was Scottsdale, Arizona, pretty affluent area, but very fast growing. And
still growing.
I learned the retail side of mortgage lending. And eventually I became the senior loan officer that managed the builder customers that were buying new homes from tract home builders that we financed the construction for. That was my total job, was to understand FHA, VA, USDA, Fannie Mae, understand that and make sure those borrowers got qualified and got their loans closed on time as soon as the house was finished. And so that was a really good education for me. And that's kind of what exposed me to new construction and the need for new homes and what that means to a consumer when they buy their first home. And so I thought that was a very satisfying experience to see the look on people's faces when they moved into their brand new home, beautifully built. They got a good loan. They had a good experience. And so that's kind of how I got started. And with a national mortgage company, I later became a branch manager in Houston, Texas. And after that, I migrated over to a mortgage company that was owned by the largest home builder in Texas, which at that time was Suburban Homes. And so I did the same thing, managing all the purchase money loans for the customers of Suburban Homes. At that time, they had probably 20 different housing subdivisions going across the country. And it really helped instill some understanding and knowledge of what other people go through to make the sacrifices to buy a new home. In this case, new construction, entry level, first time home buyers, and that type of stuff.
Sure.
And so that really kind of cemented my interest in the mortgage industry, particularly as it pertained to new construction. Shortly after that, I went to work for the nation's largest home builder, which at the time was U.S. Home. And I ran a division of U.S. Home Mortgage for that group. I think when they went out of business, they were taken over by Lennar. But U.S. Home at that time was the largest home builder in the United States. And I had Arizona and California, and I managed those divisions. And so later in my career, I went to work for a savings and loan, doing something very similar, managing the retail loan origination department. And my introduction into the savings and loan industry is where I learned the art of leveraged lending, which I knew nothing about. I was clueless. I didn't realize that savings and loans had all these special privileges at the time that, they could make 100% loans without any mortgage insurance. They could do all kinds of weird, strange things. And so because I worked for a savings and loan, I was able to learn more about construction lending and how banks, savings and loans dealt with tract home builders, acquisition, development, and construction, land loans. And was through that experience and the eventual savings and loan crisis that took down the savings and loan that I worked for. And so I was packing my bags ready to move out of there when the bank closed, and the president of the bank, the new president, came in and said, "Hey, we want to make you a job offer." And I thought, "What do you mean you're making me a job offer? I just got fired. How come you're making me a job offer?" The job offer was about staying on and working as an asset manager under the FSLIC, which was later replaced by the Resolution Trust Corporation. And so that's where I learned all the bad things that can go on with a construction loan, things that you're not supposed to do, things that you should avoid. And so I was the cleanup boy, on aisle number 9, trying to clean up open construction loans, subdivision loans, land loans, things of that nature. And that insight is really what gave me the ideas about, don't do this, don't do that. This is going to lead to a failure. This
Shannon,
is going to lead to a foreclosure.
That's all great. So for our listeners and for some of our credit union members out there who are maybe thinking about getting into construction loans or who are starting to dip their toes into it, what are some of those lessons that you learned?
Well, the biggest lesson that I learned is that there's no industry standard for originating and managing construction loans.
You taught me that. You taught me that, right? It's pretty much whatever my appetite was, go for it, right?
Right.
I was smiling at some of the lessons, and you saying that you're a cleanup boy. I won't share the name of the organization that I was with, and I think I may have told you this story when we were developing, my construction to perm program, but I was with an organization that had a construction to perm program, and it wasn't really monitored, wasn't really checked in on, but it got fully drawn. And, the executives happened to be in the area where this $1.5 million house was being built. And so they were like, "Hey, let's go take a drive at this. It's going to be a beautiful home." They drove by, and it was just the framework, and it was already fully drawn. And so, and I think I already shared that with you back a couple of years ago, but I started laughing when you said that you're the cleanup boy. I was like, God, I can't imagine some of the things that you have seen. And I use that bad example, but I mean, you hear about stories about that all the time, especially when you're developing construction of perm, right? Very fascinating. It really is. Anyways, continue. I interrupted.
Well, some of the lessons, Justin was asking about, and that I could mention would be understanding, what the use of funds are for a construction loan. And many lenders do not understand the theory of acquisition cost, what is actually financeable inside of a construction loan. And so we preach that hard and heavy. And And we see lenders all the time closing loans, only to find out later, oh my God, there was never enough money in the loan to finish the house in the first place. And so
I imagine you probably hear about that a lot more nowadays, right? And maybe not so much now because the cost of a 2x4 has gone down dramatically from its peak and during the pandemic years, but that had to happen quite often in recent time, right?
Oh yeah, we've seen that, and it's just because there isn't really any standard in the industry. It's not written on the wall somewhere. It's not in the Fannie Mae selling guide. Where do you go to actually understand what are the best practices for originating and managing construction loans? And so we've tried to take the best practices that I have learned and that the company has learned and incorporate that into our technology platform. And it includes things like, you don't disperse the money until the work is complete.
Right.
That's pretty basic, but you would be shocked how many lenders, the contractor said they need money, send them some money. But the work's not done, and so this is where the joke comes from inside internally at Land Gorilla when a contractor calls us and said, hey, I need some working capital, or I need some walking around money.
Don't we all?
You're going to get some walking around money after you get some work done on that job site. But oftentimes lenders don't know that they write the rules, the golden rule. We have the money, we make the rule.
Yep.
You get work done, we'll give you an advance, we'll give you a payment.
Yeah. The funny thing is, and I'm not trying to make this about a sales pitch, about Land Gorilla. But we obviously signed up with you at my last organization, and the amount of pushback I got from the fact that we were using you guys was actually shocked, right? Because and oftentimes, and I heard about this before, and I actually experienced it at past organizations before I got to Lafayette. A lot of times the builders think that they're the ones controlling this process, right?
Yeah.
And oftentimes, all too often, lenders, doesn't matter if it's a credit union, doesn't matter if it's a community bank or IMB, they kind of just bend over it with the hopes that, hey, if we play nice in the sandbox, they'll refer business to us, right? But the problem is that, that's, especially when you think about a credit union, that's your members' money, right? It's not just the individual members' money, that's the entire membership's money that we're focusing on. And so, you guys protected us like from a lot of big issues that possibly could have popped up. Just that simple idea, like you don't give them money until the work is done. It's just you think it's common sense, but all too often, especially with construction to perm, even reno, that's not happening, right? Anyways, I really want to go to the main conversation. We're kind of we kind of jumped ahead in time a bit, but I do want to focus on the big conversation. The credit union space, right? Seem to be, for the most part, you have some credit unions that do construction to perm or some form of renovation, a true renovation, not like a HELOC renovation, but a true renovation product. But it seems like credit unions tend to be a little bit far behind in adopting this product. So let's have a conversation on the opportunities that lie ahead for credit unions to really start considering construction perm or reno as a viable option for them in today's market. So I welcome your thoughts on it, Shannon.
Sure. Well, it all comes for credit. The thing I love about credit unions is you guys are really good about identifying the needs of the credit union members. That's your top priority. And I love that. We don't see that with community banks. We don't see that with mortgage companies. And so I love that you look at it, what are the needs of the credit union members? And the needs are, there's not enough homes anywhere in the country. There's a housing shortage. We could be 4 or 5 million housing units short right now today. And so that's why credit union members come to you to say, hey, can I get a construction loan? Can I get a lot loan? I've got a lot in escrow. I want to close a construction loan. And so construction loans are great ways to develop, real estate earning assets on the book of the credit union. And those loans can be portfolio or they can be saleable in the secondary mortgage market or a combination of the two. On the renovation side, there are many renovation loan products that are saleable in the secondary mortgage market. FHA 203K, home style renovation from Fannie Mae, choice renovation from Freddie Mac. But I think the bigger opportunity for credit unions is to identify needs that are coming from your members about ADUs. This is a big topic. And when I say ADU, I'm not talking about an accessory dwelling unit per the definition from Fannie Mae. That's not what we're talking about. We're talking about additional dwelling units, ADUs. And this is what we're seeing across the country. And many credit unions are already deep into this. And this is just a case where a homeowner wants to build an additional dwelling unit on the lot that their house currently sits. But it doesn't have to be an accessory. It doesn't have to be de minimis to the primary residence. It could just be a second home. And that kind of follows the zoning trends across the country that your credit union members are seeing. California is probably the biggest state for that.
I think there are a few states that recently adopted.
They are, and they're kind of following the steps of California, which essentially they've eliminated single family zoning in California.
Right. I want to say like a few weeks ago, I read about Austin essentially doing the same thing. And, the problem with Austin is that not so much, the land's there, right? Enough of these houses have space to kind of fit in that zoning requirement for that additional unit. The problem is Austin hasn't built out the utility infrastructure to support the additional units. And I think that's the big concern with those, right?
Yeah, no, definitely. And that's a big cost. It's a big expense. That takes long-term planning, whereas an additional dwelling unit, if you have, a 20,000 square foot lot, sure, you could put another 1,500 square foot home on the lot.
Sure.
And you make use of the existing utility accessibility. The streets are already there.
When you started down this, this part of the conversation, you kind of hinted at something, right? It's like, yeah, inventory is there, right? But it's still, we're still not at the peak of where inventory has been in the past. One thing I find interesting is like, okay, well, you may not have existing home inventory, but there's land out there, right? So there's land, right? There's plenty of lots that are for sale around a lot of major metropolitan areas,
right?
So in many ways, if you factor that in, there's a massive need because why buy an existing home when you can build your own? The tough part, I guess, is for credit unions to wrap their head around is the fact that, and I could be wrong, like most of the time building your own home costs like, I don't say like half as much, right? So they're not half as much, like it is a negative. So like 50% more than what it does to buy an existing home, right? And I'm right about that, right? So like it's obviously more expensive to build your own home, but you kind of said something earlier, not so much in this conversation, in the past conversations we've had, that construction of perms not so much rate driven. It's not so much the loan amount driven. It's more features driven, right? So if you provide an outlet for someone to be able to build a home, right, they will build a home. Is that right?
Right. No, I would agree with you on that. And construction lending is very much feature driven. I mean, the decision that the consumer makes, it's not really about the interest rate. I need the lowest interest rate for a construction loan. It's never about that. It's more about, well, can I include the cost of the lot inside the construction loan? Can I include contingency reserves to be funded from the loan amount so that I can cover unforeseen costs that I might have? Interest reserve is always a big one. Many lenders do not want to fund interest reserve from the loan proceeds. Yet that's pretty much the standard of the industry. Very few borrowers can make their rent payment on the home that they're living in now, plus the interest payment for the construction loan. Most can't make both payments at the same time. That's why you fund interest reserve.
Right.
So it is very much feature driven, the term of the loan, and most consumers, they're not experienced at this. They don't know this. They don't know that they should interview the contractor. They're relying on the credit union to vet out the builder, to say that builder's okay. They're relying on that.
Right. So let's come back to let's go ahead. Hawk, go.
I was going to say, I actually find that really interesting because from a marketing perspective, when I worked for the same credit union Peter did, we focused a lot on features. We focused on the features and we focused on the process more than what the rate was.
Right.
Because that was,
that's like when you talk about you should never really market rate.
Yeah, well, that's true. But when you talk about the psychology of like what people are really interested in, there's some science to it that just says they're more interested in learning about what they're really going to get out of it in the deal versus like that rate.
Right. No, I think that's a really good point. And I had a developer ask me back in my earlier years as a loan officer the question when I was soliciting business from the developer that was a broker developer. And the broker asked me, you give me one good reason why I should send my borrowers to you, refer loans to you, and I'll seriously consider it. And so my stupid answer was, well, I've got the lowest rates in town. That's why you'd want to do it. And the real estate broker told me, see there, you failed, because it's not about the interest rate. It's about getting the escrow closed. It's about meeting the needs of the customer. That's what I wanted to hear you say, but you didn't say that. So you're out. You failed. And so that was a very hard lesson for me to learn. And to this day, I repeat that lesson to the people at Land Gorilla and to clients. It's not about the rate. Rate is always important. It's an important consideration, but it's not the reason that they make the decision to go with a certain credit union or a certain lender. It's how are you going to treat me? You're going to meet my closing requirements. You're going to meet the builder's requirements to get paid on time, the subcontractors and all that type of stuff.
Right. And Shannon, when we first started today's podcast, I told you it was going to fly by, right? Here we are about that time that we need a transition. But, it's amazing how quickly it goes by.
Sure it does.
Give me some final thoughts on the opportunity that lies ahead and why credit unions really should consider a construction and perm product in their organizations. Final thoughts.
I think at the top of the list, the direction and the interest is coming from their members. The members are telling you, we need a house. We can't find a house. Prices are high. I have an opportunity to build. That's a big opportunity for a credit union. We have credit union clients that are very large in the space of providing financing for a lot, to purchase a lot. They're not ready to build, but I need a lot loan, and I've got 10 or 20% to put down for a lot, and I'm planning to build 2 years out. Well, now that's a credit union that has set the stage for making that type of a loan to a member, knowing that they're coming back for the construction loan. And they're not shopping around. They're not shopping price when they come back. They just want the construction loan.
Totally right.
A renovation loan as well.
Yep.
So there's just great opportunity for credit unions. For the most part, credit unions have the liquidity. And if they're going to have liquidity issues, they can always sell these loans at the completion of construction to free up that liquidity. I have a lot of credit unions that churn these loans in and out of their portfolio. And so these are good earning assets. The other thing that I love about this is that these construction to perm loans, guess what? They're all owner occupied. Mm-hmm. That's the loan that's going to least default.
100%.
They're owner occupied, and you've got the borrower's total motivation and all their equity, years of planning to get into this. They're motivated. They're not going to let that house go. It's not going to look like the financial crisis, in the 1980s, where I put 5% down. I'm just going to let it go. It doesn't work that way on a construction loan because they have significant equity into the transaction long before you ever get to the point of closing the construction loan. So lots of opportunities for credit unions. In the old days, the community banks owned this space, but they pretty much exited out, after the Dodd-Frank Act and the TRID disclosure debacle and all that stuff. And so who's stepping in to take the place of the community banks? Well, it started to be the mortgage companies. Now it's the credit unions.
Right.
You can own this space. A credit union could own this space.
Wouldn't that be something? Wouldn't that be something? Well, hey, Shannon, we need to start pivoting. We're at that time where we have to start moving to the second segment. My final question for you before we do so, what keeps motivating you to have this passion for our industry, to keep helping credit unions or in any lender really just really understand this very confusing product type? I mean, I will say this. I've spent hours on the phone with you in product development. I've met with you in person for hours. Actually, we had met at a conference, and what was supposed to be just a 30-minute meet and greet ended up being an hour and a half where we talked about construction. What keeps motivating you to kind of keep having this passion?
I guess the answer to that would have to be because the housing market is in trouble.
Okay.
And I have knowledge and experience that can help everyone.
Sure.
You know,
I like that.
Land Gorilla has got great technology, yes, but it's not all about the technology. It's about understanding what's the best practice to encourage lenders to make these construction loans and stay out of trouble. And because there's no real book, one of the best practices on the road. And so that's really what motivates me, to see lenders be successful at this.
Okay. I like that. Thank you very much. All right, so let's go ahead and pivot to our second segment of the podcast. Now, this is a segment of the podcast where we, do, dad jokes. We play Jeopardy. Sometimes we have trivia. But today we're going to play a little, ranking game where I kind of ask you a question. I say, hey, can you rank the top 5 or top 10, whatever it is within this subject? Now, just a short bit ago was Valentine's Day, and I think we're going to do a little. The three guys are going to do some Valentine's Day trivia. I think we're experts on this at this point. But real quick, I have to ask this question. Let's do a little trivia first before we get to the rank of this Valentine's Day, we'll say, ranking trivia thing. Do you guys put the two of you put a lot of emphasis on Valentine's Day?
Like, you mean with my spouse?
Yeah. I mean, no, just like with a random person. Yes, with your spouse.
A random person, definitely. With my spouse, no, not at all. To me, it's just a commercial holiday.
Okay.
For me, it's all about all about my grandkids.
There you go.
Because it's a holiday that they enjoy.
This one, I found this interesting. Only about 30% of men and actually 30% of women believe that Valentine's Day is a special occasion. Right. So I found that interesting. Only about a third of the U.S. population feels as though it's an important holiday. But what's interesting is that, okay, so you have a third of the U.S. population only finds that this is going to be, or this is a special occasion. When you think about, so I looked this up on the National Retail Federation of America. Americans are going to spend roughly $22 billion this year on Valentine's Day gifts.
Whoa.
So that's a lot of chocolate.
That is, what's a lot of whatever people buy, whatever it is that people buy. So it's interesting. Very, very, very interesting. So that brings me to my segue of the ranking. So let's focus on, okay, so we now know $22 billion. That's what Americans are going to spend, this year on Valentine's Day. What are the top 5? I have 6, 7, 8, 9. I have the top 12. What are the top 5 Valentine's Day gifts that people give to their significant other, partner, spouse, partner? I think I already said that. What are the top 5? So Shannon, we'll go with you. What is your number 1 gift that people give in general? Not just you, but in general. What's the number 1 gift that people give on Valentine's Day?
Money. That's what they all want.
That's
always nice.
Let's just throw away money. Right?
Card. Okay. It's always nice to get a card, but in my group, in my family, it's always money. That's the motivator.
All right. Justin, number 1 Valentine's Day gift that people are going to give?
Chocolate.
All right, chocolate. Okay. All right, so we have chocolate and money. All right, number 2. What's the number 2 gift given on Valentine's Day? And I'll share the top 12 when we're done. Let's just go through the top 5. What's number 2?
I think dinner out, an evening out. That's a common one.
I will say that is on the list. That is on the list. It's not. But Justin, what's your number 2?
Jewelry.
Jewelry, also on the list.
Of course.
Of course. I mean, if you're going to get the $22 billion, it has to be jewelry, right?
Gotta have jewelry.
You gotta have jewelry. Okay, let's do number 3. All right, so we got a whole bunch of different ones. I don't remember what they were, but keep going. All right, so what's your third, Shannon? What's your third?
I think third might be clothes.
Clothes, okay. Clothes. That is on the list. That is on the list.
I've got a lot of women in my family. I've got a lot of granddaughters. It's always about clothes.
Clothes. Justin.
A teddy bear or a stuffed animal.
Stuffed. That's actually not on the list.
Really?
That's a good one. That's a good one.
If I had to give my kids a Valentine's gift, one of them would ask for a squish something.
Squishmallow.
There you go, Squishmallow. Those things. Yeah. We only have 40 of them, but he would need one more.
All right. Let's give me one more. Shannon, what's your fifth in your top 5 gifts on Valentine's Day?
Oh, well, for me, it might be babysitting because I've got 3 children and 7 grandchildren and, numerous others. And so my wife and I do a lot of babysitting, watching the grandchildren so the parents can go out and, have a Valentine's Day dinner or a vacation. So babysitting is big on my list.
Okay. Hawk.
Flowers.
That's not bad. All right. So here's the list. Okay. The most popular Valentine's Day gifts in the US. Number 1 is candy. 44% of Americans will give candy as a gift.
So my chocolate falls into that category. Yep. Cool.
Number 2, yes, chocolate falls into candy, Justin. It does. Number 2 is just a simple greeting card. Happy Valentine's Day or I love you, stuff like that. A simple greeting card is number 2. Number 3 is flowers. 4 is a romantic dinner. Number 5 is wine, just wine in general. Wine as a gift, which I think we all can get on board with that. Number 6, you have gift cards, which I find that one actually the most interesting as a Valentine's Day gift because nothing says, here's an impersonal gift to someone I care about. But it's most certainly on there. It's number 6. Number 7, jewelry. Number 8, clothing / shoes. 9, perfume / cologne. 10, lingerie, underwear, or pajamas. 11, some type of event ticket, like a concert, a theater, or just a movie ticket. And then just you have a general other as number 12. And only about 5% of Americans give a gift other than the ones listed prior to, which is very interesting.
Oh, Shannon, we did a great job. We did great.
Now the survey does group what others are. They could be like a romantic trip. They could be like cosmetics. It could be a pet as another gift, which I found very interesting. I don't think
I would enjoy that.
Someone giving you a pet?
No.
like, does it bring different feelings if you give someone like a goldfish versus like a dog, like a puppy? Like,
do you know how much work a fish is?
Oh, I would never buy it. Never.
I made that mistake.
God. No.
And I was so sad when they all died, but boy, I couldn't. I was so happy. I didn't have to clean that tank anymore. It's so much work.
Danielle grew up with like a fish tank in her house, and she's like, "We should get the kids fish." I'm like, "That's never gonna happen. Like, never, ever, ever." 1, it's a lot more work than a dog.
Yeah.
2, I'm already taking care of the dog. I'm not gonna take care of a fish tank. 3, what happens when Goldie, the goldfish, dies and we have to flush down the toilet? The kids will be devastated. So no, thank you. So never gonna have a goldfish.
Buy one that you can just replicate over and over and over again.
Oh, is that the secret?
Yeah.
Okay. No, but I'm still not gonna have it. No, it's way too much work. Never. Yeah. But again, if someone gives you a goldfish, you just like them. But if they give you like a puppy, they really like it.
I think if someone gives me a pet, they really don't like me. And they just want it to make my life a little bit harder.
Says a person who just got a dog.
I mean, I've had him for over a year now, but yeah.
All right. Well, Shannon, thank you very much for being on today's podcast. Really enjoyed having you.
Certainly.
Always enjoyed talking to you. So again,
pleasure to be here, and welcome any opportunities in the future.
Yeah, awesome. Justin, again, thank you as always for playing co-host on today's podcast. Always appreciate you being here. And kind of just to close out, everyone else, thank you very much for taking time out of your busy schedule to join us on our fun little podcast. We hope you enjoyed it. Keep an eye out for the latest and greatest happening over at ACUMA. Until next time, catch you later.
Thanks for listening. We'll see you next time at the ACUMA On Point podcast. If not already, be sure to subscribe and give us a 5-star rating. For more great episodes and information, be sure to visit us online at acuma.org. And to get the latest updates, head over to our LinkedIn page.